On today's episode, we're breaking down everything mortgages related. We're talking about what they are, how they work, and how they matter for your financial future.
We are back in your life, and today we are talking about mortgages, debt, homes 101. Michael, in a previous life, we used to do this thing called Money Bites.
I'll bring back Money Bites, man. I love Money Bites.
Tell us about the core concept of Money Bites.
They were just short 30-second video clips where we explained financial jargon to you in plain language so that everyone had the knowledge you could all understand.
So this is like a longer version of Money Bites. If you want us to bring back Money Bites, put it in the comments. It will troll our marketing team to no end, and I would love to do it.
The intro was the best bit.
Yeah. Somebody's definitely going to clip that up. So, Mike, I think when it comes to like those who are looking to buy their first home, there is a lot of jargon in there. It can get a little bit complicated. The banks like to think it's essentially on purpose, isn't it?
It's opaque by design, right? And if you go back to throughout history of finance, the technical jargon, when you're speaking between people who work in finance, is appropriate because you need to be accurate, and usually you're working under pressure of time, so it needs to be like quite quick conversations. But when you start using that with customers, all it's really doing is providing a situation where you can charge a fee and they don't know why.
Yep. It is a good business model. To be fair, it's worked well for the banks. But let's jump into, Mike, some core topics questions. I'll ask the questions, you answer them.
Yeah, go for it.
What is a deposit?
A deposit. So a deposit when you're buying a house is the portion of money that you have to put down, and that then combines with the portion of the money that the bank loans you, and that makes up the total purchase price. There's actually two kinds of deposits. The first deposit we call your purchase deposit. That's when you actually have just purchased the house. So you've either won at auction or you've gone unconditional on your sale and purchase agreement. You've usually got to put 10% down. So that's basically put some skin in the game so that the vendor knows you're not just going to walk away, at any point because they've got some money of yours. And two, the real estate agent gets paid. So that's why the real estate agents will hassle you about making that deposit payment pretty quickly.
Those Porsches are expensive.
They are. Now, that can become a problem if you're using KiwiSaver as the majority of your deposit, because if I put my hand up at an auction and I go, yeah, sorry guys, I'll get you that deposit in, 10 to 14 working days, they'll go, nah, you got to pay it now. So if you're going into auction or you are using KiwiSaver as basically the majority of your purchase deposit, your upfront deposit, you got to let the real estate agent know, hey, it's going to take me a little bit of time to get that deposit.
Yeah, but I'm good for it. I feel like with the KiwiSaver bit, that would be quite a common misconception that people go like, I'll tell them I need it and then they'll just give me the money straight away.
Well, they just don't think about it, right? Because KiwiSaver is something that happens in the background by design. You're not meant to think about it. So they don't realize it's a managed fund. It's an investment.
Yeah.
So that's the purchase deposit. You've then got the balance of your deposit, which is just your deposit. So let's say I put down 10% up front at the auction, and I've got another 10% that I'll put down on settlement day. So the day when I actually get the house. So let's say I'm buying a house for $1 million, paid $100,000 when I won the auction, pay $100,000 a couple weeks later when I actually buy the thing, and then the bank puts in $800,000 when we buy the thing, and that makes up your $1 million purchase price.
So the 20% piece, this is where people can go wrong quite a lot and think they're a lot further away than they necessarily are. Is it always a 20% deposit?
Absolutely not. I would say maybe 40% of our customers have a 20% deposit when they buy their first home. And you can buy a home with as little as a 5% deposit. 5% deposit loans, they're a specialist thing. I don't specialize in them, but they have some limits there that you've got income caps, I think house price caps, things like that as well. So definitely this is where people kind of think I'm actually really far away, I need 20% deposit, and actually they've got 5%, they could get into something straight away. Important point to note with those 5% deposits, at the moment, you're not getting charged penalty interest. So if you've got a 5% deposit, you would potentially be better off than someone with a 10% deposit who's getting charged penalty interest, because Kāinga Ora is underwriting, or the government is underwriting those 5% deposit loans, so they're less risky.
I talk to some people and they go, I don't want to have a small deposit. I want to wait till I have a larger deposit, a smaller loan, owe the bank less money. That makes sense in theory, but why is that potentially a bad idea?
It's potentially a bad idea if the market's going up, because then you're trying to outsave a moving market, right? And you're saving in, you've got $50,000, then $51,000, $52,000. If your $1 million house is going up 5% per year, it's probably going to be outstripping your savings pretty quickly. Maybe at the moment, you could argue that you could probably wait a bit and save a bit more, but I don't think there's a ton of time left at the bottom. But when the market is increasing, trying to outsave a moving market is very difficult.
Yeah, people have forgotten about that, right? Like house prices have gone up for a minute.
Yeah.
You can definitely forget that lesson, but interest rates have been coming down for a while.
And even at the moment, just to jump in, if you buy now, we're kind of on or near or just past the bottom of the market. Let's say you buy with 10%. You're going to have the value of your house increasing and you paying off the debt, which will get you that 20% equity that you potentially should have had at the start. Whereas if you bought in 2021, everyone who bought with 10% deposit there, the value of their house has gone down. I spoke to someone today who was just today actually, they have 20% equity in their home based on the purchase price. The purchase price was 1.01 mil. And it is now 875,000. So they literally they've paid off enough of their loan that, compared to that 1.01 mil, they've got it. But unfortunately, that house price has dropped in unison.
We've talked about a deposit, the mortgage, why you don't need a 20% deposit. How do we pay off our mortgage faster?
There's really only two ways you can pay off your mortgage faster. You can increase the repayments or you can decrease the interest cost, right? Like that is literally it. There are a ton of different strategies that people have around credit cards, revolving credit facilities, timing your pay coming in and this and all this sort of stuff. And that does mathematically work. Again, all you're doing is kind of reducing your interest cost a little bit, but it is very hard to stick to that over time. And it is very hard to stick to that if you don't have a financial advisor on you all the time checking in if you've done it right. We see a lot of people who watch a whole lot of YouTube stuff and go, yep, I'm going to do this really fancy strategy and try and pay it off early. Very rarely does it work. You just increase the repayments and decrease the interest cost.
Yeah, bang on. I mean, people are just looking for cheat codes, right? They're looking for the easy way. But fundamentally, you got a big mortgage, you got to pay it off.
Yeah.
There's 1,000 ways people can go, and some of the crap that I see around, like, this is the way to clear your mortgage in 15 years. Newsflash, you're just paying off the mortgage faster.
Yeah.
I've got a great example for you, Mike, that I've used on Sorted for an $800,000 mortgage. So the minimum repayment a week is $1,000.
Mm-hmm.
On that scenario, we're paying $1,000 a week. Do you know how much interest you pay?
At the first payment?
Across the term of the loan.
$800,000 mortgage, 1.7?
$800,000 in interest you pay. So your total
repayments by
is pretty much double. So you get an $800,000 mortgage, you pay $800,000 in interest. Yeah. That would surprise a hell of a lot of people. Now, if you increase those repayments to $1,500 a week, your interest costs go from $800,000.
I reckon it drops to about under half.
350,000, bang on, just under half. And the last one for you, for those playing at home, if you double your mortgage repayments, you go from spending $800,000 in interest over the term of the loan to
180 something.
You're pretty good at this game, Michael. You should look at a career in mortgages. $227,000 in interest. The other bit here as well is you go from paying off a mortgage in 30 years. So say you buy your first home at 30, right? So you go from 30 to 60. Yeah. That's assuming you don't upgrade, doing your renovations, those sort of things. So 30 to 60, you save yourself not just $600,000 in interest, but you pay off your mortgage in 10 years instead of 30 years, right? And people are looking for this like magic bullet about how do I do it? It's pretty simple, right? Like we talk about you don't rise to your goal, you fall to your processes. And this is just increase your minimum mortgage repayment. Yeah, you can muck around with revolving credits if you like, but we've just over time, we believe like the simpler the better.
We've talked about revolving credits a little bit, so we may as well dive into what it is.
Yep.
Yeah, cool. So a revolving credit facility is just a large overdraft that is secured against your house. So let's say you took out a $500 overdraft on your bank account. You can dip in and out of that as much as you like. And that facility limit, that $500 limit remains there, right? A revolving credit is just that, but a bit bigger. So it might be $50,000, $100,000, $200,000. We've seen $8 million revolving credits. So, it's basically a giant overdraft you can dip in, dip out of. They are good if you have lump sums coming in. So if you're self-employed, they are good if you have patchy income, if you have bonuses that are coming in, or if you are really disciplined with your money. If you know that you manage your money really well, you saved up a good deposit to buy the house, you've done everything right, you're not saying to yourself, I don't spend a lot, but at the end of the month, I don't know where it's gone. If you're not saying that to yourself, a revolving credit might be right for you.
I would say 15 to 20% of people, a revolving credit is right for them.
Yep.
And what do you reckon? 50% of home buyers probably have a revolving credit?
Yeah, I'd say so. They're becoming, well, in here, they're becoming less popular because we don't like giving them out because our ethos is you pay down the debt and people just dip into them, right? Like people literally just keep dipping into them. We used to do the thing where I was like, cool, we'll put 20 grand on revolving credit. You guys chip away at it. I'll see you in a year for our annual review and we'll shuffle some debt around and pay some bits off. A year later, they still owe 20 grand.
Mike, the next concept I'm keen to explore is equity. We hear a lot about equity. It can get quite confusing and there's big implications around whether an investment property is possible or not. And I'm keen to do that after this break.
Whether you're buying your first home or restructuring your mortgages, Lighthouse Mortgages can help you out. Get in touch with our team of specialist mortgage advisors via the link below. Now, back to the show.
Okay, Mike, so I want to talk about equity, but I think it's important we talk about some of these other loan products first. So what else do we have to work with? An offset is usually quite comparable to a revolving credit?
Yeah, so an offset facility is offered by a couple of the banks, and that's basically a revolving credit facility, but spread across a couple of accounts where you've got the debt in one account, so the loan, and then savings accounts. Those savings accounts are linked back to the debt, to the mortgage account, and the difference between the savings and the balance of the loan, you pay interest on that. So if you've got one mortgage account with $100,000 and you've got two savings account with $25,000 each in them, you'll pay interest on $50,000, which is the difference between those two savings accounts and the mortgage.
So revolving credits versus offsets, which one do I pick?
Revolving credit is a transactional facility. This is something that you get paid into, you spend out of, you leave money in there over time and hopefully it pays itself off. An offset facility is not a transactional facility. These are really good for keeping things separate. So if your parents want to help you out by reducing your interest, they might set up an offset account. So they go, cool, in this account here, I give you 100 grand, it sits in that account and it offsets the loan. So it's reducing your interest cost. But we know in that account is my money. In the next account, you might have your partner self-employed, maybe they're a bricklayer or something, and they get paid in lump sums, or they have to save their provisional tax. You might put the provisional tax in the other account. So you can kind of utilize all these different accounts, but it's really clean for the accountants and to manage it as to kind of what's actually offsetting.
Nice. And so fixed versus floating.
Yeah.
I hear 1,000 different strategies. Some people just do like 1 year fixed over and over. Some people do like 1, 2, 3, 4, 5 and split it all up.
Yeah.
In Australia, floating is really common.
80%.
Yeah. Explain to us fixed versus floating.
Cool. So let's start with a floating. A floating interest rate is a variable interest rate. So it can go up or down. So basically, you are not locked in to any rate. It can change any time of the day. The advantages of a floating facility are basically two. One, if interest rates are falling sharply, you might want to stay on floating because your interest rate's coming down. Or two, you can make lump sum repayments onto that loan at any point in time, right? So your floating interest rates are higher than your fixed interest rates. And basically what that means is you are paying a premium for the ability to go, I'm going to pay this mortgage off whenever I want. You'll still have minimum repayments, weekly, fortnightly, monthly, but you'll be able to chuck 10 grand in, 5 grand in, $1,000 in whenever you want without any penalty.
So Mike, that's floating. Tell us about fixed mortgages.
Yeah, so a fixed interest rate is just the opposite, right? So your interest rate is fixed and it is cheaper than a floating interest rate. You can't make additional repayments, or sometimes there's like you can make 5% per year or this or that or some little ones. But for all intents and purposes, the repayment is locked and the interest rate is locked for a set period of time. The interest rate is lower because basically the bank is going, I know how much money I'm going to make off you because you're going to lock it in for a term, 1 year, 2 year, 3 year, 4 year, 5 year. So I'm willing to take a little hit on the interest rate to give you some certainty.
Nice. Okay, so they're all the lending products. Let's move into probably the one that, we got to unlock our equity. How much usable equity do we have? Can you break down what is equity? Why should we care?
Yeah, cool. Equity is just the difference between the value of your house and the value of your mortgage. So that is basically the equity you have in the property.
Percentage of the house you own.
Yeah, correct. That's still not your usable equity though. When people talk about equity, what they really want to know is how much usable equity do I have? Your equity is how much you'll get if you sell the property. Usable equity is how much you can borrow against the property. So if I've got house worth $1 million, I've got a $500,000 mortgage, I can lend to 80% of the value of that property. I've got 300,000 of usable equity that I can get out.
So there was some scenarios where I don't need a 20% deposit, but in that scenario, I have to have 20% equity with the bank. How does that work?
No, you've got to have under. So you can buy a house with less than 20% deposit, but that's it.
Right.
You can't then borrow any more. You've got to get it to 80%. Then usually your interest rates come down a little bit. Then you've got to get under that, and then you can reborrow it back up to 80%. And that's the real key. You are borrowing the bank's money back. It is not your money. And that's where everyone gets confused. When I go, it's a full application if you want to go get 200 grand to go buy a house. They're like, why? I've paid this loan off. I'm like, yeah, you've paid it off. We've got to go borrow it back now.
Yeah. It's not your money. It's the bank's money.
It's still the bank's money. Yeah. It's your money if you sell the house. Yeah. It's the bank's money if you're going back and borrowing it.
Yeah. Which seems fair enough.
Yeah. Well, you'd think so. Yeah.
Mike, the last one I want to know about is principal and interest versus interest only, because I hear them all the time.
Yep. So those are just the two repayment structures that you can have. Principal and interest is what it says on the tin. You are paying your interest cost and some of the principal off. And it's usually that principal is calculated over a 30-year term, and you'll just slowly chip away at it. So your first repayment will be like 99.9% interest and 0.001% principal. And then by the time you get to the last one, it's 99.9% principal, 0.1% interest. So it's just a big straight curve of you paying the loan off. Interest only, that is when you're not paying any principal off. So if you put a loan on interest only for 30 years, you'll owe $1 million on day one and $1 million 30 years later, right? You're not paying any principal off. That's really good for investment properties. But some people do it on their owner occupied properties and they get into trouble because they just leave it on there for too long, and then they've got a really short period of time with really high minimum repayments to try and pay it down.
And the bank will test you if you can make those repayments on that shorter period, right?
Yeah, absolutely. One of the more commonly asked questions we get around interest only and principal and interest is if people can have interest only with less than 20% deposit. Same as offsets and revolving credits. They go, hey, I've got 90%. Can I get a revolving credit or an offset, or can I have interest only? You can't. You got to have 20% equity, 80% loan or less to have any of those products.
All right, well, they're the commonly asked questions that we get when it comes to mortgages, when it comes to buying a home. So, Michael, thank you for sharing all your knowledge. Much love to Lighthouse Financial for sponsoring this episode. Please subscribe to the channel, give us a review, give us a like, and we'll catch you next time.
Cheers.